Banker to banks. Like individual consumers, businesses, and organizations of all kinds, banks need their own mechanism to transfer funds and settle interbank transactions, such as borrowing from and lending to other banks and customer transactions. As the banker to banks, the central bank fulfills this role. In effect, all banks operating in the country have accounts with the Reserve Bank, just as individuals and businesses have accounts with their banks. As banker to banks, central bank focuses on facilitating intermediation, enabling smooth, swift and seamless clearing and settlement of interbank obligations, efficiency in operations, providing an efficient means of funds transfer for banks, minimum cash balances to handle withdrawal needs, enabling banks to maintain their accounts with central bank for purpose of statutory reserve requirements and maintain transaction balances. Savior in bad times, acting as lender of last resort. The central bank provides similar products and services for the banks what banks offer to their own customers. Here is a quick look at them. Non-interest earning current accounts. Banks hold accounts with the central bank based on certain terms and conditions, such as maintenance of minimum balances. Banks draw on these accounts to settle their obligations arising from interbank settlement systems. Remittance facilities. Banks and government departments can use these facilities to transfer funds. Loans and advances. The central bank provides short-term loans and advances to banks or financial institutions when necessary to facilitate lending for specified purposes. Lending of the last resort. This is one of the main functions of central bank. It is clear from the above discussion that the total amount of money stock in the economy is much greater than the volume of high-powered money. Commercial banks create this extra amount of money by giving out a part of their deposits as loans or investment credits. It is also evident that the total amount of deposits held by all commercial banks in the country is much larger than the total size of their reserves. If all the account holders of all commercial banks in the country want their deposits back at the same time, the banks will not have enough means to satisfy the need of every account holder, and there will be bank failures. All this is common knowledge to every informed individual in the economy. Why do they still keep their money in bank deposits when they are aware of the possibility of default by their banks in case of a bank run? The central bank plays a crucial role here. In case of a crisis like the above, it stands by the commercial banks as a guarantor and extends loans to ensure the solvency of the latter. This system of guarantee assures individual account holders that their banks will be able to pay their money back in case of a crisis, and there is no need to panic, thus avoiding bank runs. This role of the monetary authority is known as the lender of last resort. In a nutshell, we can say that central bank provides liquidity to banks who are unable to raise short-term liquid resources from the interbank market because of weak financial situation. Central bank then pitches in to protect the interests of depositors of those banks, which in turn has a stabilizing impact on the financial system and on the economy as a whole.